There are three things happening in the economy right now. Three things that most people don't understand. And if you don't understand them, you're going to keep making financial decisions based on an economy that no longer exists. It doesn't matter if you're an experienced investor, if you're just starting to think about your financial future, or if you simply want to understand why your money doesn't seem to go as far as it used to. These three things affect you directly. Your wallet, your job, your family, your future. And the problem isn't that the information doesn't exist. The problem is that nobody takes the time to explain it clearly, without unnecessary jargon, without political agenda, and without catastrophizing. Because the reality isn't that the world is ending. The reality is that the world is changing. And there's an enormous difference between those two things. The first of these three things, the United States government is spending money it doesn't have, every single day, without stopping, at a scale we've never seen before. The second, the US dollar, which for more than 80 years was the most powerful and influential currency on the planet, is facing a real challenge for the first time in decades. And the third, China. The Chinese economy is growing at a pace that has the most important banks in the world, the most respected economists on the planet, and the most sophisticated investors in the market reviewing their strategies and asking very uncomfortable questions. But before you think this is another alarmist video predicting the collapse of the economy, stop. Because it's not. In fact, the central message of this video is exactly the opposite. Because history teaches us, with numbers and with data, that every time the economy goes through a major period of change, two things happen simultaneously. There are people who panic, make bad decisions, and end up worse off than before. And there are people who understand what's happening, position themselves correctly, and build wealth precisely because everyone else was scared. The question you should be asking yourself is not, how bad is this going to get? The right question is, where is the money moving? And that is exactly the question we're going to answer today. Stay until the end. Because we're going to break down each of these three topics with clarity, with real numbers, with concrete examples. And by the end you'll have a completely different perspective on what's happening, and on what you can do about it. To understand what's happening with China, we first need to establish a foundation. We need to talk about how the size of an economy is measured. The indicator used universally is called GDP, Gross Domestic Product. It's basically the sum of everything produced, sold and consumed within a country during a year. It's the thermometer of a nation's economic health. Today, the United States economy has a GDP of approximately $31.8 trillion. China's economy has a GDP of approximately $20.8 trillion. At first glance, the United States is clearly ahead, its economy is almost 50% larger. So what's the concern? Why are serious economists talking about China with such urgency? The answer is in one word: speed. The US economy is growing at a rate of approximately 2.1% per year. China's economy is growing at approximately 4.6% per year, more than double. And when you apply those growth rates over time, the result is inevitable. Mathematicians have a word for this: compound interest. The same principle that makes your investments grow exponentially if you leave them long enough. Applied to economic growth, it means that an economy growing slower than another will eventually fall behind. The most important banks on Wall Street, including Goldman Sachs and JP Morgan, project that by the mid-2030s, in less than 10 years, the Chinese economy will surpass the American economy in nominal size. Some economists say it could happen even sooner. But here comes the part that very few people know about. And this part completely changes how you should interpret those numbers. There's a concept called purchasing power parity, PPP. And this concept tells us something fundamental. It's not enough to compare how much money each economy has in absolute terms. You have to compare what that money can actually buy within each country. Because a dollar doesn't buy the same thing everywhere. Let me explain it with an example everyone can understand. Imagine you have $100,000 in cash and you want to buy a home. If you go to Manhattan, the heart of New York City, with those $100,000 you probably can't buy anything at all. Not even a parking space. But if you take those same $100,000 and go to a mid-sized city in the American Midwest, like Des Moines, Iowa or Columbus, Ohio, you can buy a 3-bedroom, 2-bathroom house with a backyard and a garage. The money is exactly the same. What changes dramatically is what that money can buy depending on where you are. Now apply that same principle to the Chinese economy. China has a deliberate and systematic economic policy of keeping its currency, the yuan, artificially undervalued relative to the dollar. It does this for a very concrete reason. When your currency is cheaper, your products are cheaper for the rest of the world, and that drives your exports. It's the reason why made in China products have dominated global markets for decades. But that policy also has a very important side effect. It makes China's nominal GDP appear smaller than it actually is when measured in dollars. Because you're converting yuan to dollars at an artificially low exchange rate. When the International Monetary Fund, the IMF, the world's most important financial institution, adjusts China's GDP using purchasing power parity to reflect what that money can actually buy within China, the result is revealing. Those $20.8 trillion in nominal terms actually represent purchasing power equivalent to approximately $35 trillion. Which means that adjusted for PPP, the Chinese economy hasn't just nearly caught up to the American economy. It's already bigger. This is not an opinion. This is not a political argument. It's the standard methodology of the IMF and the World Bank. And it's the reason why the most serious financial analysts in the world have been paying close attention to this for years. And the United States knows it. That's why it's not responding with armies or traditional diplomacy. It's responding with economic tools. Massive tariffs on Chinese products, not just to raise revenue, but to make Chinese imports more expensive and force manufacturing back to American soil. Unprecedented restrictions on China's access to advanced semiconductors, the cutting-edge chips that are the fuel of artificial intelligence, because whoever controls semiconductors controls the technological future. Geopolitical pressure on the oil flows that supply China, because cheap oil is what allows China to keep its production costs low. And China is also responding. Buying gold at a historic pace to diversify its reserves and reduce its dependence on the dollar. Pushing the use of the yuan in international commercial transactions. And leading and expanding an alliance of countries known as BRICS, originally 5 nations, Brazil, Russia, India, China and South Africa, but which today already includes more than 20 countries with the explicit goal of creating alternatives to the dollar-dominated financial system. This is an economic war in every sense of the word. It's not fought on battlefields. It's fought in currency markets, in global supply chains, in trade agreements, and in semiconductor laboratories. And its consequences will define the map of world power for the next several decades. What we just saw about China leads us directly to the second major topic, the US dollar. To understand why the dollar is so important and why any change in its global status is front-page news, we need to go back to 1944. At the end of World War II, the Allied powers met in a small town in New Hampshire called Bretton Woods to design the new international financial system. At that meeting, with the American economy absolutely dominating the world stage, a historic decision was made. The US dollar would be the world's reserve currency. What does it mean to be the world's reserve currency? It means 2 extraordinarily powerful things. First, that the countries of the world store their wealth, their national savings, their emergency funds, their strategic reserves, in US dollars. Not in euros. Not in yuan. Not in gold. In dollars. Second, that the majority of large international transactions, oil, metals, agricultural commodities, commercial contracts between countries that aren't even the United States, are conducted in dollars. This gives the dollar something no other currency has, guaranteed and constant demand from the entire world. And that constant demand keeps the dollar's value high, even during periods when American fiscal policy wouldn't justify that value. Think of it this way: if the entire world needs dollars to do business, the entire world has to constantly buy dollars. And that constant buying creates demand that sustains its price. It's as if the world's best-selling product were the American dollar. But that extraordinary power is being challenged for the first time in 80 years. In the year 2000, 71% of all international reserves in the world were denominated in US dollars. That number represented an almost total dominance of the dollar in the global financial system. Today, in 2025, that percentage has fallen to approximately 58.5%. 12 percentage points less in 25 years. Is that a collapse of the dollar? No. Absolutely not. The dollar is still by far the world's most important reserve currency. But it's a trend. A clear, consistent, and sustained trend over time. And in economics, trends matter more than one-time events. Central banks around the world are diversifying their reserves. They're buying more gold. Central bank gold purchases in recent years have reached historic levels. They're exploring trade agreements in other currencies. And some countries, like Saudi Arabia, which for decades sold its oil exclusively in dollars, in what was known as the petrodollar, have begun accepting Chinese yuan in some transactions. This phenomenon has a name: de-dollarization. And it's the gradual process by which the world reduces its dependence on the US dollar. Why does this matter to you? Because the dollar is not backed by gold. It's not backed by any precious metal or any physical asset. Since 1971, when President Nixon severed the dollar's link to gold, the dollar has been backed by one thing only: trust. The trust that it will maintain its value. The trust that the US government can and will honor its obligations. The trust that the American financial system is stable and predictable. And when that trust starts to erode, even gradually, even slowly, the impact can be significant. Because a dollar that's worth less in relative terms means imported inflation. It means everything you buy that comes from outside the country, electronics, clothing, oil, raw materials, costs more. It means the purchasing power of your savings decreases over time. And this connects us directly to the third topic: the debt. Let's do a very simple exercise to understand the fiscal situation of the American government. Imagine you manage a household. This year, your household is going to bring in $5,000 in income. But your expenses are going to be $7,000. Those $2,000 difference you have to borrow. And next year the same. And the year after. And the year after that. That is, in essence, what the United States government is doing. This year it's going to collect approximately $5 trillion in taxes. And it's going to spend approximately $7 trillion. The deficit, the difference between what comes in and what goes out, is approximately $2 trillion. Every single year. The cumulative result of decades of spending more than it collects is the national debt. And today that debt exceeds $39 trillion. To give you a concrete reference, that's more than the annual GDP of the entire American economy. Meaning even if the world's largest economy stopped everything it does for an entire year and dedicated all its income to paying off that debt, it wouldn't be enough. But the problem isn't just the size of the debt. The problem is its cost. And here comes the data point that should concern us most. When the debt was smaller and interest rates were low, as they were during the pandemic era, when the Federal Reserve dropped rates close to zero, the cost of paying interest on that debt was manageable. But interest rates rose significantly in recent years to fight inflation. And when interest rates go up, the cost of the debt goes up. The result, today, the fastest growing expense in the American government's budget is not national defense. It's not Medicare or Medicaid. It's not Social Security. It's the interest payments on the accumulated debt. Of every dollar you pay in federal taxes, approximately 20 cents go directly to paying interest. Not to building roads. Not to funding hospitals. Not to paying soldiers. Just to interest on debt. And that leads us to the most important concept in this section: One that economists have been warning about for years but that very few people outside the financial world know about: the debt-death spiral. The debt-death spiral occurs when a government reaches the point where it has to borrow new money to pay the interest on the debt it already has. It's exactly like using a credit card to pay the minimum on another credit card. It works in the short term. But every time you do it, the total debt grows. And the cost of that debt grows with it. Until the moment arrives when creditors, the countries and investors who lend money to the government, start to doubt whether the government can pay. And when that doubt appears, they demand higher interest rates to compensate for the risk. Which makes the debt even more expensive. Which makes it harder to pay. Which generates more doubt. It's a cycle that accelerates on its own. Are we at that point today? No. Not yet. But trajectory matters. And the current trajectory is concerning. Economists like Ray Dalio, one of the most successful investors in history, have been warning for years that if the United States doesn't change its fiscal trajectory, that scenario is possible within the next decade. What would happen if that occurred? The consequences would be broad and deep. Mortgage rates would rise significantly, buying a home would be even harder than it is today. Car loans would become more expensive. The overall cost of credit would increase for everyone: families, small businesses, corporations. The stock market would face enormous pressure. And employment and wages would feel that impact. Now add it all up. A Chinese economy growing more than twice as fast as the American economy and increasing its global influence year after year. A dollar whose global dominance is gradually eroding. A national debt growing out of control with costs reaching unprecedented levels. Artificial intelligence transforming entire industries and displacing jobs. Rising oil prices adding inflationary pressure. All of this happening at the same time. Not in different decades. Now. Does that mean the economy is going to collapse tomorrow? No. But it does mean that the economic environment of the next decade is going to be radically different from the last one. And preparing for that different environment starts with understanding it. Every time I explain these three topics to someone, there's a very common reaction. The person says, "We've never seen anything like this before. This is different from everything that happened before. This time is worse." And I always respond the same way: let's review history together. Because the history of the American economy, and of the global economy, is the history of one crisis after another. And it's also the history of how smart money always found opportunity in those crises. To understand this clearly, let's do a simple comparison. Let's look at 50 years of data, from 1975 to 2025, and compare three things: how much people's income grew, how much the prices of the things they need to buy grew, and how much financial assets grew. In 1975, the median income in the United States was approximately $11,800 per year. Today, in 2025, it's approximately $80,000. That seems like impressive growth, almost 7 times in 50 years. But now let's compare the growth to the price of things. A median home in the United States cost around $38,000 in 1975. Today it costs approximately $417,000. That's growth of almost 11 times, significantly more than income growth. A new car cost around $5,000 in 1975. Today it costs close to $50,000. Also 10 times more. 1 year of public university cost $540 in 1975. Today it costs around $12,000. That's 22 times more. And health insurance for a family of 4 cost around $550 per year in 1975. Today that same insurance costs approximately $24,000 per year, growth of 44 times. Stop for a moment and process those numbers. Your income grew 7 times. But the house you need to buy multiplied 11 times. The car you need to get to work multiplied 10 times. The university for your children multiplied 22 times. The health insurance for your family multiplied 44 times. That gap, between the growth of incomes and the growth of prices, is exactly why so many people feel like they're working harder than ever but getting ahead less. It's not a perception. It's not unfounded complaining. It's pure mathematics. But now here comes the part that changes everything. Let's look at what happened with assets during that same period. $10,000 invested in 1975 in U.S. Treasury bonds, the safest and most conservative investment that exists, practically guaranteed by the government, would have grown to approximately $80,000 by 2025. That's 8 times. Better than income growth, but not enough to keep up with the cost of a house or a college education. $10,000 invested in gold in 1975 would have grown to approximately $200,000 by 2025. That's 20 times. Much better. Gold was an excellent store of value, especially during periods of inflation and crisis. But gold doesn't produce anything. It generates no dividends. It generates no rental income. It only goes up or down in price. $10,000 invested in real estate as a rental property in 1975, not as a home to live in, but as an investment that generates monthly rent, would have grown to between $800,000 and $1 million by 2025, considering both the appreciation in property value and the rental income accumulated over 50 years. That's between 80 and 100 times your initial investment. The difference from gold is fundamental. Real estate doesn't just go up in price. It also works for you every month, generating passive income. And $10,000 invested in the S&P 500 index in 1975, the index that groups the 500 largest and most powerful companies in the United States, would have grown to approximately $1.4 million by 2025, assuming you reinvested all the dividends. That's 140 times your initial investment. 140 times. Over 50 years that included the oil crisis of the 70s, the recession of the 80s, the market crash of 1987, the Asian crisis of the 90s, the collapse of dot-com companies in 2000, the worst financial crisis since the Great Depression in 2008, and a global pandemic in 2020. Through all of that, through every crisis, every recession, every moment when the world seemed to be on the brink of collapse, $10,000 invested in America's largest companies grew to $1.4 million. What does that tell us? It tells us that the difference between the people who built wealth over the last 50 years and those who didn't wasn't their income level. It wasn't their education. It wasn't their luck. It was whether they invested or not. And what type of assets they chose. People who only relied on their salary saw their purchasing power erode silently. People who put their money to work in real assets saw their wealth multiply generation after generation. Now we arrive at the most important part of this video. Because everything we just analyzed, China, the dollar, the debt, 50 years of history, doesn't make sense if we don't connect it to what you can actually do today, with the information you have right now. And the first step is to change the question you're asking yourself. Most people, when they hear about these changes in the economy, ask themselves, how bad is this going to get? Should I take my money out of the bank? Should I buy gold? Should I prepare for the worst? Those are the wrong questions. The right questions are, where is the money moving? What sectors, what assets, what opportunities are being created by these changes? How do I position myself to benefit, rather than just protect myself? Because money always moves. Always. In every crisis, in every recession, in every period of economic uncertainty, money doesn't disappear. It moves. It leaves some assets and enters others. It leaves some industries and enters others. And the people who understand where the money is moving before everyone else are the ones who generate wealth in those periods. Look at the historical examples we already saw. In the 1970s, there was a devastating oil crisis, runaway inflation, and interest rates that reached 20%. The stock market fell dramatically. Many people lost their savings. But gold multiplied fivefold in that decade. Real estate prices rose significantly. The people who understood that dynamic and positioned themselves correctly didn't just preserve their wealth. They multiplied it. In 2008, during the worst financial crisis since the Great Depression, the stock market fell almost 60% from its peak. It was terrifying. But the people who kept their investments in the S&P 500 and kept buying during the fall saw the market fully recover in 3 years and reach new all-time highs in the years that followed. In 2020, during the COVID-19 pandemic, the market fell 34% in just 4 weeks. The fastest drop in history. And then it recovered completely in less than 6 months, reaching new all-time highs. The pattern is consistent. People who panic and sell when everything falls are the ones who crystallize their losses. People who understand that downturns are temporary and opportunities are permanent are the ones who build long-term wealth. So what does this mean for the current environment? It means that the gradual de-dollarization we're seeing could continue driving gold prices higher in the coming years. Because when central banks around the world reduce their dollar reserves, they have to put that value somewhere. And historically, much of it goes to gold. It means that the economic war between the United States and China is creating opportunities in certain industrial sectors, domestic manufacturing, semiconductors, energy, that are receiving unprecedented investment and policy support. It means that the real estate market, while expensive in the short term, remains historically one of the assets that best protects against inflation and generates superior returns over the long term. And it means that the stock market, despite the volatility this environment may bring, remains the most powerful vehicle for building long-term wealth for people who have the patience and discipline to maintain their strategy through turbulence. The investor who wins is not the one who predicts exactly what's going to happen. It's the one who builds a solid strategy, based on principles proven by history, and maintains it with discipline through economic cycles. If you only depend on your salary to build your financial future, inflation, rising cost of living, and changes in the economy are going to keep eroding your purchasing power. Not because you're irresponsible, but because that's how the system works. But if you start thinking like an investor, if you start understanding that wealth is built through assets, not income, then these changes in the economy aren't a threat. They're a map. A map that shows you where the opportunities are if you know how to read it. The economy is always changing. It has always changed. What separates those who prosper from those who fall behind isn't luck or perfect timing. It's financial education. It's understanding how money works. It's making informed decisions instead of being driven by fear or euphoria. And that's exactly what this channel is about. Financial education without complications. Money clarity. So let's do a quick summary of what we learned today. Number 1, China. The Chinese economy is growing more than twice as fast as the American economy. And adjusted for purchasing power parity, it's already larger. That is changing the balance of global economic power and moving money toward new sectors and opportunities. Number 2, the dollar. The dollar's status as the world's reserve currency remains solid, but it's being challenged gradually for the first time in 80 years. That trend has real implications for inflation, the purchasing power of your savings, and the cost of living in the coming years. Number 3, the debt. The American government is on a fiscal trajectory that is not indefinitely sustainable. The cost of that debt is growing faster than any other line item in the budget. And if that trajectory doesn't change, the consequences for the broader economy could be significant. But above all, and this is the most important thing, history teaches us clearly that every period of major economic change is also a period of enormous opportunity for those who are prepared. Crises don't destroy wealth. They redistribute it. And they redistribute it toward the people who understand what's happening. Your job is to be one of those people. If this video gave you a new perspective on what's happening in the economy, I ask you one favor: give it a like, share it with someone you think needs to hear this, and subscribe to the channel so you don't miss the next video. because we're going to keep breaking down exactly these kinds of topics, with clarity, with data, and without catastrophizing. See you in the next one.